There we go. Make sure I get everybody in there. The participants are all in, 58 of them. Okay, everyone. Thank you for being patient with us for 6 minutes before we get started, but we're going to get through this quickly. I'm Paul DeSoki, and I'm CEO of Stony Hill Advisors. And joining me today is soon Richard Strautman. He's one of my partners, and Chuck Goldblum, who is with Hurley Capital. And I'm not going to be speaking long. I'm going to start by introducing myself. I'm the founder and have a background in commercial lending and the telecom industry, and but I've been doing this for 13 years. Richard is joining us. He's one of our associate of ours, and he'll introduce himself in a minute. And I'll tell you quickly about my company. We are a full service small business advisory firm. When we talk about small business, we're talking in general businesses that generate at least 1 million in revenue, and we top out at about 50 million, because those businesses are a little beyond our capacity, and they're mostly competitors with the big investment banking firms. But in this market that we serve, and it's called the lower middle market, there are many thousands of companies, and actually millions of companies. And a white paper I wrote a couple years ago, we identified 6 million small businesses owned by baby boomers, not just anybody. So there's a lot. We approach the concept of exit and merger work around a holistic approach, helping business owners exit the business, but also create a better solution and increase the value of the business for the ultimate exit being the most beneficial possible. That's our goal. That's our mission, is that it's not just to find a buyer, but to make the business find the best buyer and make sure it's more valuable. So we have offices in Pennsylvania, New Jersey, Ohio, Connecticut, New York, North Carolina, and just recently we've opened up an office in Southern California. So our list of services, we call it exit value coaching. That's the process, typically 3 to 5 years before an exit, where a business needs to work on getting ready and increase the value through reducing risk factors. And we're very experienced at identifying risk factors and recommending ways to reduce those risks. And we have partners, much like Chuck, who will come in and help in a variety of ways to achieve the end result of a very successful exit. We do the M&A work as well. We find buyers, and we also help business owners in those last 3 to 5 years identify, add-on businesses, things that make them increase their value by
recording in progress.
By having businesses that are, if you get bigger, it's more valuable. You can. This is a general statement, but it's mostly true. You can buy a company that has positive cash flow and use that company's positive cash flow to pay any loan you take to buy that company. You have to put up some money, you have to do some expenses to integrate, but over the long term, that business becomes free. You've gotten it for using its own money to pay the loan back. We recommend doing that. That's a part of our process of helping a business owner get ready for exit. So our advisors are very good at helping business owners understand the best way to exit. So I think I have the next one on my slide too. Yes, I want to talk about a new service that we just introduced. We call it exit value planning services, and this goes back to the exit value coaching I mentioned. We have formalized the process to a service using a platform that delivers the content, so that it's not just us telling business owners what they should be doing, but we have many components, and we call courses, that are available. There's videos, there are articles and things to review and read. There are spreadsheets available, and we customize access to the Stony Hill Academy process so that when we're working with a business owner, we can deliver all that content most effectively to what is needed to get that business ready for exit. So we're going to be promoting this over the next few months as a good way to really get a feel for how to get your business, higher value and make it ready for exit. I don't know if Richard's on yet, so I'll continue until Richard can join us. So, exiting a business is something most people on the audience here have been, kind of working toward for their career. They started the business many years ago, 20, 30, maybe even 40 and 50 years ago. And you reach a stage where you want to retire. You want to access the wealth you've created. You want to provide a legacy. You want to make sure that your customers and employees have a future in that same business. And so that's what we're about. It's a process of making sure that you have the best exit possible and not just walk to the end of the line and close the business or in many cases we face people who become ill and they're forced to close the business or sell it at a significant discount. Or this presentation is more about the way you can save money doing the exit. When you're having somebody acquire your company, there are many tax management strategies that we'll talk about here, and that's the purpose of this session. The agenda, we're going to talk about things that can be implemented in advance and should be done ahead of time. We're going to talk about areas that once you have a letter of intent offer, things you should be doing as you're getting ready to complete the transaction. There are strategies for implementing savings after the transaction is closed, and we'll discuss some of the risks and rewards of the tax minimization strategies here. We have a Q&A component. We'll answer questions at the end. Just type them into the Q&A box, and we'll get to them. We left some time for that purpose too. So I'll turn it over to Chuck, and you can continue.
Do it. Let's do it. Thanks, Paul. I appreciate the intro. Thanks for hosting this event. It's a exciting time in the world of M&A. I know that lots of private equity firms continue to dominate the space, continue to looking to add businesses to their roster and scale it up for the benefits of their investors and really for the benefits of the folks who sell. And we'll talk through a few scenarios there. So just as a quick intro of our business, Hurley Capital, we're a financial advisory firm, and we focus on the personal financial risks and opportunities for wealthy individuals and families with a focus on business owners and sellers. What I like to say is, you guys are, and perhaps women as well, are really great at doing your business. And here's a time as you approach a business sale, we're going to crystallize it. But this is unless you're a serial entrepreneur, the one and only time you're doing this. And it's going to be hopefully for a giant amount of money. And I want you guys to approach that with the same skill set that you do in running and building your business. And so I'm going to give you some tips here on how to do that. But I have to say, I see time and again, owners get some of the critical items wrong, which is just leaving money on the table for the government, table for the buyers, and I want to help get you there. At Hurley Capital, our two focus areas are tax and estate planning opportunities around business ownership, sale, and investments, and then helping the wealthy people gain comfort in their financial future by, one, helping them plan out finances post-sale. You'd be surprised at the size of the deals that owners and sellers, they fear they're going to outlive their money, regardless of business size sometimes. Two, minimizing taxes along the way so owners can keep as much of their hard-earned money as possible. And then three, investing afterwards while not taking undue risk to reduce the ups and downs in markets. And we're independent registered investment advisors, so that means that, since we don't work for a big financial advisory firm like an investment bank, we don't have any client sales goals or products to sell, we just sell advice. As we'll touch on further in this presentation, although we'll talk about tax and legal things, I'm not an accountant, I'm not a lawyer. We work with lots of them, So we're going to give you ideas that you can bring to your service advisors, and to the extent you don't have those, I'm happy to make referrals. Not in the business of getting finder's fees from them. It's just folks you can talk to about it. So in any case, and to the extent I make a recommendation, I'm happy to facilitate in the call, help facilitate the calls and participate in them. So let's, Paul, maybe go on to the next slide. So as Paul said in the intro, we split these opportunities into before, during, and after the transaction. It's very discrete periods when there are opportunities to do things. So the things we're going to talk about in the before options, for the most part, you can't really do them during the transaction. And you certainly can't do them after the transaction. And anyway, so we'll talk through these. There's a big list. We're not going to cover all of them. We're really just going to cover what I see sort of are the greatest hits, really what the things that people I see doing a lot of. And like I said, if you have questions about any of the details, we can cover some of it in the Q&A, put it in the chat box. We'll look at it afterwards. Let's get started. All right. So like I said, you'll see on these slides, it's a ton of information. I'm not going to read it to you. You can either read it along the way or go to the Stony Hill guys and ask them to send you a copy, or I believe this will be online afterwards. You can snap it out afterwards. In any case, these before strategies, really valuable, especially for wealthy owners, right? So a lot of wealthy owners are thinking about estate planning, but also as we'll go through it, you'll see it can work for other folks as well. But I do think it's applicable most for business owners with businesses of value of at least 5 million, maybe even over 10 million, and certainly beyond that. These before strategies they share a common approach, which are what are called freeze trusts, where you freeze the valuation of a asset in order to put it into a trust. So the grantor retained annuity trust, or GRAT, is sort of the simplest one to understand. It basically works like this. If I'm a grantor and I put, let's just say this basic scenario, I'll put $2 million into a GRAT, and I'll set it up for we'll call it a 5-year GRAT. You can do a 2-year, you can set whatever time you'd like. Let's say I put a $2 million into a 5-year GRAT. I will then set up a schedule on the setup of the GRAT for a return of that cash flow over 5 years plus interest. So in this case, it will be $400,000 a year plus interest. The government establishes a minimum allowable interest rate. That's called the AFR, something you can Google. And the idea of the GRAT, where the benefit of the GRAT is to the extent this $2 million I put in grows, maybe I invested in stocks or whatever the case may be, any overage beyond what the GRAT pays me back is for the beneficiaries of the GRAT, in which, many times it's the grantor's children. So a business owner contemplating a sale might get their business appraised several years ahead of a sale at a much lower valuation. And as this GRAT plays out, there'll be a lot left over for the beneficiary. And an actual benefit of one of the key benefits of this is that this overage is not considered a gift. And so if you are let's go to the next slide, Paul. As an example, I like to talk about, I know you went backwards. There we go. So one up. As an example, wealthy folks who have large asset bases well in excess of the current lifetime gift allowance of 12.9 million are always looking for strategies to transition assets to their beneficiaries without using this 12.9 million. And so a GRAT is a great way to do that. And like I said, the further ahead of the transaction you can do this, the easier it is to get an appraisal that is accepted significantly below the final transaction value. So let's just move on to the next one. Let me talk through an example that we did with a client in California who we actually only met quite close to the sale date of his business. So in his case, his company sold, he had an insurance brokerage, sold for $100 million. His share was 2/3 of that, so 67 million. While he only set up this trust about a month before the sale, he was only able to get a 10% discount on the valuation of his firm, even though he had a letter of intent in place. The discount was really based on the percentage likelihood that the deal might not actually happen. So in this case, he was able to sell his piece of the firm to a trust for the benefit of his kids for $61 million, thereby allowing his kids to get $6 million of value, like I said, outside of the lifetime gift allowance. The trust paid him back with a promissory note. We could talk about the details of this in the Q&A if you'd like. One very cool thing about this, like I said, he was in California. The nature of these out-of-state trusts, this one was established in Delaware, a state without capital gains tax. One of the real benefits was the trust, which owned the business ahead of the sale. The trust was not liable to pay capital gains tax until the assets were distributed to the beneficiary. So in this case, the trust continues to hold these assets, continues to invest these assets, and only when they're distributed do the beneficiaries incur state income tax. And truth is, to the extent the kids don't live in California, they'll never be state income tax. So furthermore, one last thing, as this was a grantor trust, the tax on the sale was paid for by the business seller himself, allowing more of the assets to stay in the trust. So you can see lots of different benefits of these sort of estate tax benefits and then tax mitigation benefits of setting up these trusts. All right. So this is a different type of trust, the charitable remainder trust. This is more of a during strategy. Because there's no benefit associated with a several year ahead sort of valuation approach. A charitable remainder trust is used to, remember, you think about it. If you're selling your business, and I keep referring to this, let's say a $10 million amount. For most business owners, this is going to be their biggest income year of their life. So a lot of the during and after strategies are about taking that big income hit, we call it a hit, the big income amount, and spreading it out as much as possible. A charitable remainder trust has that plus a charitable benefit. So let's walk through the example here. A typical $10 million sale, ahead of the transaction, and it can be quite close to the transaction, the owner moves the business to a charitable remainder trust and then sets up an income stream from the charitable remainder trust. Let's say the $10 million, the owner could set up, let's say, a 20-year income stream of $500,000 a year. So on the transaction, there would be no taxes to the business owner as the sale would be to the sale would be from the charitable trust. The business owner would then get 20 years of income. And by the way, that income would be taxed appropriate to what taxes were due on the trust. So there's also, assuming, and you wouldn't do this, the assets would be invested. If there's any investment tax that's higher than capital gains rates, that would be taxed first. But then most of the assets coming out of the charitable remainder trust will be subject to capital gains tax. And oh, by the way, to the extent you are a resident in a high tax state and you choose to retire to a tax-free state, well, now you're not even paying the state income tax. So that's one benefit. You've spread out the income. The second benefit is that at that time of creating the trust, you can calculate what the remainder of the trust will be after the tax payment, right? So even if you're going to take a full $10 million out over 20 years, you can impute some sort of expected income in the trust, investment income in the trust that might be left at the end. The business owner at that time will be able to take a taxable deduction based on the discounted imputed remainder that goes to charity. So not only are you avoiding the giant cap gains hit up front, you're actually getting a taxable deduction. Let's keep going, Paul. Very important. This is one we see missed a lot. These days, as you know, a lot of the transactions in the middle market are with private equity buyers. And in many cases, the private equity buyer pays for the deal consideration in cash and in stock. They want the owner to remain involved in the business and committed to the business. And part of the way they do that is to give them stock. And one thing we see is owners paying capital gains tax, not just on the cash, but also on the shares received, thereby making a much higher effective tax rate on the remaining cash. And so what we tell folks is that in an asset sale, which is what a lot of these private equity deals are, in an asset sale, we want to see sellers use IRC code 721 to enable to split the deal. It's not a separate contract, it's just written up in the contract that allows some of the assets to be swapped for cash. That piece will be taxable, and other assets to be swapped for stock. That piece would not be taxable, and the owner would retain the same low cost basis they started with on the received stock, right? And a great benefit of that not only is saving on the taxes or getting a deferral on the taxes, but also in the unfortunate situation that the value of the stock goes down, well, then you'd pay taxes on a lower amount, and vice versa. We can answer questions on that as we go. Another thing to think about when you're in a transaction is if you're a C Corp, you might qualify for QSBS consideration, qualified small business stock. You can Google section 1202. This typically applies only to C Corps that are selling and C Corps that have been around for 5 years, and on stock that is original stock. So stock not bought off somebody else, but bought from the company or created on establishment. So there are, we see this a lot in the technology sector. We see it some cases in the B2B sector. There are a lot of excluded categories from QSBS, including my favorite, financial services, but also a lot of the personal services type businesses, such as legal, such as insurance brokerage. Those are often excluded, and as you can see here, it's a $50 million limit. We should all be so lucky, but that's something we could talk about, Paul. And then let's talk about after strategies. One thing I didn't touch on earlier, basically the after strategies are all strategies that you might use on an annual basis, but sort of souped up. And so what I mean by that is, to the extent that you can supercharge money into a retirement account, you would do that. And in this example here, donor advised funds, it's a means of supercharging donation. And here's what I mean by that. Let's just say you donate $20,000 a year to charity, pick a number. I might recommend to you, hey, why not put away $200,000 this year in your deal year for charity? A donor advised fund allows you to segregate this money, put it into a different account. It is considered a donation at that time, yet you have not distributed it to your final charities yet. And so then you would, for each of the next 10 years, if you so choose, distribute that money to charity. And then you wouldn't get the write-offs in year 2 through 10, you would just get this one write-off in year 1 of $200,000. And there's no actual restriction on when you make those donations. So to the extent you wake up in the morning and don't want to give the 20 this year, great. Give the 20 next year, give whatever you want, whenever you want. So there's no restrictions there. It's just a great benefit. And a lot of the brokerage firms will create those segregated accounts for you. Last thing I want to touch on, I believe, is opportunity zones. These were very popular when they first came out. They were part of the Trump tax cut 2017, but there are 2 key benefits here. One, so remember, so you're investing in an opportunity zone with capital gains only, right? So you get 2 benefits, and I'll describe what it is. Benefit 1 is that any capital gains you invest in opportunity zone are delayed taxation until the 2026 tax year, so 2027 payments, number 1. Number 2, if you hold the opportunity zone investment for over 10 years, it is not subject to capital gains. So to the extent you actually make money on it, off you go. It's a real benefit. So let's talk about what an opportunity zone is. Let's go to the next slide. Part of the Trump tax cut incented investment in areas that need investment. So you can Google your town, your state for opportunity zones. Every state has them, many towns have them, and they are either businesses in these communities or real estate developments in these communities. It's not buying a property there, it is buying a property and developing it. So I've seen this done with entrepreneurs who want to do a development themselves. And we often also facilitate investments by clients into third-party sponsored funds. Typically, those are real estate developments. We can talk more about that further. That is opportunity zones. And I think that is the end of my section. I'm gonna kick it back to Paul. No
Okay.
Q&A.
Thank you, Chuck. That was very helpful. Chuck and I went over back and forth. There's another potential strategy that you need to take under advisement, but it's deferred sales trust, and it's being watched closely by the IRS. So we didn't present it today, but so we want to provide enough content to give you ideas. We recommend you talk to your tax advisors, your financial advisors, and think ahead. Even the after strategies can be kind of mentally prepared for, even though you're not executing on them until after the transaction. But you can do the financial planning on a spreadsheet or what have you to get an idea of what the after-tax benefits will be from selling your business. I've seen many occasions where there's a shock when the time comes, you get a good offer, and then you realize what the impact will be on taxes. So think ahead. That needs to be done. And that goes back to what we said about our exit value planning efforts. We're trying to increase the value so that the shock is minimized, because there's enough room to pay the taxes and still retire very, very comfortably. So we've went through these. I don't need to go over them at all, but
Hey, Paul, should I answer the question that we've got here in chat?
oh, I can go there. Yes. Chat.
So so there's basically one question in chat is typical expenses setting up a CRAT.
Okay.
And basically I would use sort of as a rule of thumb, you could probably do it for less. I think $3 to $5 grand. I think it really depends. It really depends on what it is. And you know, I think truth is you could probably find it on LegalZoom. But for me, I often want the comfort and guidance of an experienced trust and estate attorney to talk me through any of the hiccups that I might want to see along the way. But I would say $3 to $5 grand if it's simple. And truth is, I haven't seen them be super complicated.
Right. And the next question was about email and the slides. We can email the slides if you prefer. We are recording this presentation. We're going to have to edit the beginning a little bit, and then I'll be able to get this out to everybody that also attended. So we want to make sure that you have this information after this ends. If there are other questions, keep adding them to the Q&A. So this is, Chuck and I, we appreciate your time today. I want to add, there's a deferred sales trust. I won't spend time on that. I'll skip over that. So what I want to mention is this. I forgot. We are doing these seminars, these webinars monthly. We've been doing them since last May a year ago. So this is like the 13th. We have scheduled another webinar on July 26th. We're working on the topic, but it's likely to be what is known as personal readiness to exit. It involves a tool that we have using the Value Builder system, and it's an assessment to help business owners understand their personal readiness to exit. As the name would suggest, you can sell a business, which you've been running, but you also have to think about what you're doing after you're no longer in charge. Now, many transactions require a transition period, might be as many as 3 years before you're able to leave entirely and 100%. So there's time to work on it then, but it really should be thought of as part of the decision to sell a business is, what am I going to do after the sale? And what else am I, it could be a coach, consultant, investor. There's lots of ways you can take it. This next webinar will be kind of delving into those topics for you. And that's mostly it. So let me see if there's any more questions. Question is, isn't forming a trust only applicable when wealth is above the estate tax exemption limit? Are you typing an answer, Chuck?
No, I can just answer on, I can answer verbally. As we discussed, certainly it's very useful for that. We also discussed the benefit of state tax, avoiding state tax or delaying state tax. And it's also for, in any case, providing upside to other people. So yes, estate tax is a primary one, but there's other applications for it.
Right. And I might mention, we've had 2 previous webinars to talk about ESOPs, employee stock ownership plans. They're regulated by the federal government, but they allow for significant tax savings. As an example, you can take the proceeds and invest it in not a 1031 exchange, but a 1043 investment, which allows you to postpone taxes on the transaction when you sell your business to your employees. The money that has been transferred to you is then held tax-free until you sell that investment. Another approach is to convert the business from a C Corp to an S Corp after the sale, and that business, if you're still part owner, because not all ESOPs are 100% transfer. If you're still part owner, the S Corp operates on a tax-free basis. So there's no more taxes paid to the federal government once that transaction is concluded. So we've talked with those in the past. If anyone's interested, we can certainly consult with you on how that fits and whether it makes sense for you guys. So there's another question. Okay, Chuck, do you want to take the next one about the 1031?
Sure. I think I need to know more about the situation to best sort of recommend options. I mean, it really, I guess I need to know more. I mean, congratulations, I suppose, but I don't want to just sort of take a swag at what the options might be. And then the last question here: what is that irrevocable trust that tax protects any growth of a business in the future, and how is it different from the GRAT? So a GRAT, an irrevocable trust is, the difference between an irrevocable trust and a GRAT is that in the case of an irrevocable trust, you're actually giving away the asset now. Right now, you might be doing it at a discounted valuation, but you're giving it away now, right? No, and by the nature of irrevocable, you're giving it away and it ain't coming back. So where my example was, hey, I've got a $10 million company that I'm going to get valued at 5 and sell in 2 years at 10, and the kids and the trust will then pay me back 5. The GRAT keeps 5, and there's no gift involved. In where it changed that to an irrevocable trust, now you've made a $5 million gift of a $10 million business to an irrevocable trust. That $5 million comes off your lifetime gift. But the good news is that they sell it then for $10 million. And so they get to keep all 10 instead of just the 5 in the GRAT scenario. I don't know if that answers the question, but you can contact me afterwards. All right, Bruce, if your business is under 2 million, where do you cut your interest assistance? I know fees might exceed 50 to 200,000. Look, I'm happy to have an intro call with anybody and go through a few of the details for your benefit. I want to see everyone do well, and that would be a sort of a free consultation. And then to the extent there's other stuff to do, we can do it or not do it, or I may refer you to somebody else. And I want to see you get the benefits you're looking for.
Yeah.
You have my contact information here if anyone needs any help.
If I understand this question too, I could add, as I've talked today and in our other webinar, our goal is to help you get your business more valuable. So you say if your business is under 2 million, well, we can help you get it to 4 million. And then you become less concerned about what it's costing to sell and other investments you have to make. And consider that a transaction is an event, but it takes time. You have the money over time that you can be investing and earning on that money that that you've saved out of the transaction. So it's a holistic approach. You have to think not just about paying taxes now on a transaction now, get ahead of the game, work on getting the business more valuable and increase its value. Any other questions? Well, thank you, everyone. Appreciate